Welcome back friends to the class number 59. In the previous two videos, we have covered the concept of DSCR and the limitations and drawbacks of DSCR. Now in the present video, we will cover one another ratio which is used in the term loan assessment cases and even in the working capital loan assessment cases, that is service coverage ratio, interest coverage ratio we can also call it. So what is ISCR, how it is calculated? So ISCR, if you remember, in DSCR, we want to check the ability of the business to pay off the interest and principal amount of the loan. But in this ratio, we only want to see whether the business is practically good enough or generating sufficient income to pay off only their interest obligations or not. So since there is no concept of inclusion of principal obligations in this ratio is not likely to be used for the term loan debts calculations. This ratio is mostly included for the working capital debts where the client is only paying the interest obligation and is not repaying the principal amount of monthly or any frequency, right? So it calculates only interest obligation. So how do we calculate the interest coverage ratio? So the formula we use for interest coverage ratio is EBIT divided by interest. EBIT is your earning before interest and taxes. In DSCR, we practically took EBITDA, but here we took EBIT, PBIT. We can also call it PBIT, EBIT, profit before interest and tax. So the formula is very simple. You take net profit before taxes from profit and loss account. You add back the interest that is debited in the profit and loss account here, then you will get your EBIT figure. Interest amount you will include of your existing debt that you tentatively that you can see from your profit and loss account itself, and for the proposed loan that you are giving, what will be the interest that will be paid on that proposed loan in next 12 months, that interest will be taken here as well, right? So the formula is very simple. We want to know the how much the entity is earning before paying the interest, and that is why we are considering that this much of income is the maximum income that the entity can use to pay off their interest, right? So if this is the maximum available income to pay off the interest, then if the entity is having this much of interest obligation, then we want to see how much umbrella cover, how much coverage that the client entity has to repay its interest, how many times of coverage that it has. So this ratio should be greater than 1. Higher the ratio, the better it is. So for practical purpose, 1.25x or 1.5x ratio is considered good, right? So when we talk about interest service coverage ratio, there are some drawbacks as well, like DSCR. Like in DSCR that we have discussed, it is also based on the past data and performance and future is uncertain. It does not take into account the principal obligations. It does not take into account the other expenses in nature which are fixed in nature, right? The EBIT does not truly reflect the cash profits. The drawbacks are similar to DSCR. It also ignores the future income and it is difficult to assess the future income as well. It does not cover the off-balance sheet debt. This point is not applicable for ISCR. If the interest is capitalized, then this ratio can be wrongly calculated if you ignore the capitalized interest amount. Then there can be varied calculations here as well. Someone take pre-tax, someone take post-tax, right? One of the major drawback that I have seen in calculation of this ratio that we are doing only net profit before tax and adding back the interest in it. We are not trying to assess the cash profit of the entity. These net profits are not the cash profits. There are non-cash expenses also which are debited in that profit and loss account, after debiting of which we have come to this figure. So these non-cash expenses which are debited in the profit and loss account should be ideally added back here, because we want to see how much entity is generating in cash which can be used to repay the interest. So the non-cash expenses are of no use practically, so we should add them back. Another point is we are totally ignoring the non-operating extraordinary income or expenses here. These profits that we are taking are inclusive of the extraordinary non-recurring, non-operating incomes or expenses, right? So these incomes and expenses can boost up, can can show your net profits 2x, 3x times even also in some cases. So if we nullify the impact of extraordinary incomes, your profit may turn negative also, right? So in that case, your interest coverage ratio can come on in negative figures, right? So this is the critical part that we are ignoring in the interest coverage service coverage ratio. I hope that this much of amendment that you can do practically when you calculate interest service coverage ratio in your organization. We will meet in the next video and we will discuss about the net cash accruals concept. Stay tuned with this channel. Thank you very much.